Have you ever heard Warren Buffett's number one rule of investing? He says, don't lose money. And his second rule, don't forget rule number one. Now, that might sound simple, but there's also a core principle that the world's most successful investors live by. Here's the thing, most normal people don't follow this. And instead, they chase the hottest returns. We jump into whatever's trending, and we forget that when you're close to retirement, avoiding the big losses is far more important than simply trying to swing for the fences. Take David Swensen, for example. He's the man who grew Yale's 100-year endowment fund from $1 billion dollars to 30 plus billion dollars in just a few decades. And you know what he said? He said your asset allocation, or how you spread out your money across different types of investments, accounts for 90% of your returns. It's not stock picking, it's not timing the market, it's just having the right mix and managing risk the right way. Because risk itself isn't bad, but here's a mistake that you absolutely want to avoid. Too much risk, too close to retirement is bad. That's what causes people to panic, to lock in losses, and possibly derail the entire retirement plan that you probably saved and invested for 30 plus years to get to. So the question you need to really be able to answer is, how much risk should you be taking, and what's the right asset allocation for you? Now, that's exactly why I built the Rule of 110 calculator on my website, The Wealth Academy. It's a simple tool that helps you get just an idea for how much risk is appropriate for you based on your age, and then you can adjust it from there based on your goals. I'm going to share my screen here and show you guys it really quick, just kind of walk you through it because it is pretty cool. And you simply select your age, right? So let's drag it over and say maybe you're 68 years old. And as you can see, as I'm dragging it, it adjusts based on your age. And if you're young, you can take way more risk in the market, right? Comparatively, as you're getting, towards retirement, you probably want to shift some of that risk to risk off. And we simply just break it down, risk on, risk off here. You enter in your retirement assets. Let's say you've got 1 million, and then it gives you the dollar figure that should be at risk in the market versus out of the market. This talks about the rule of 110, how it's just simply a investment guideline that a lot of financial professionals use to determine what percentage of your portfolio should be allocated to higher risk investments like stocks. And it does show down here, if you're taking risk on with your money, here's a different type of risk on, asset classes that you could look at versus risk off and the, more conservative asset classes there. And so once you know your number, once you have an idea of what the rule of 110 looks like for you, that's how you can build a portfolio that keeps you on track without taking unnecessary risk. So if you're getting closer to retirement and you want to avoid making the number one mistake that even smart investors make, go try out this rule of 110 calculator at thewealthacademy.com. Figure out your risk number and protect yourself from avoidable losses and retire with confidence. Because remember, rule number one is don't lose money. And rule number two is don't forget rule number one.